Hey everyone, if you're here for our 9 best startup funding options webinar, then you're in the right place. My name is Jason Ruger and I work for Fit Small Business. I'm just the tech guy today. I'm not the finance expert. That's Jeff here, who will introduce himself a little bit more here in a minute or two. But we thank you so much for coming. We're really excited that you guys can be here. A couple of quick things, just kind of as far as how the webinar is going to work. So we're not going to take live questions at the end, but I will be kind of monitoring chat throughout the webinar today and answer some basic questions. But then we're also going to have some opportunities for you guys throughout the webinar to kind of have access to some other resources where you'll be able to get your startup funding questions answered. And you can always get on the site and check out our other articles or email either of us if you have questions. Jeff probably specifically if you have finance questions. And then we will have some opportunities for you guys to check out some of our kind of recommended startup funding options as well. So we're really excited about that. But before we get started here, we were just wondering where you guys are from and what businesses you're interested in starting. Cool. So it looks like we have Bill from California who is looking to get an aquaponics business started.
What is that?
Well, Bill might be able to explain it a little bit better, but I've had actually a little bit of experience with this because my dad got into aquaponics for a while. But as I understand it, it's basically like a symbiotic, setting up a symbiotic system where it's in water and plants grow in water, and then there's also fish in the water, and the fish fertilize the plants, and the plants provide oxygen for the fish. And it's like a healthy, sustainable way to like grow, organic vegetables and stuff, and then also, raise fish.
That's really fascinating.
So it looks like Bill said that he's already started selling some of his local produce, and he's looking at maybe continuing to do that and building it up to maybe eventually a restaurant or something someday. So that's pretty awesome.
That'd be awesome. I'd definitely go to that.
Yeah.
Looks like we also have Josie from somewhere between Boston and New York. All right.
Nice.
Looking to
Welcome,
start,
Josie.
Yeah. Looking to start a floral shop. So Josie, is that online or like a physical location shop? Both.
Cool.
That's awesome.
Yeah, that's a good, tell you what, weddings and stuff, if you get in an area that has some really good wedding venues, you can do some really good business on wedding flowers and stuff, especially.
Maybe Josie and Bill should talk about how they can work together.
Catering and florist for all of your marital needs.
Yeah, there we go.
Okay, cool. Well, I think probably everyone's kind of rolling in at this point, getting settled. So I'm going to go ahead and hand it off to Jeff here, who's going to kind of walk you guys through all this info. So again, we're really excited you could be here. Thanks for coming, and take it away, Jeff.
All right. Thanks, Jason. So like you said, I'm Jeff White. I'm going to be your guide today. We're going to cover a lot of ground. So I encourage you guys, as I pull up our PowerPoint presentation that we prepared for today, that you pull out something to take notes with. All right. So you're in the right place if you're looking for the 9 best startup funding options. And this is put on by Fit Small Business. So for those that don't know, fitsmallbusiness.com is a website where experts like me publish in-depth articles for small business owners. We have lots of great resources for startups as well as more established businesses on our site, from marketing and sales to accounting and taxes to financing and everything in between. So here is my background. Again, my name's Jeff White. I've got 12 plus years of helping small businesses grow through M&A transactions, through marketing activities, and through finding financing. I have my JD MBA, and I have a lot of lower middle market private equity experience, looking at businesses and acquisitions in the range of about $1 to $12 million of EBITDA. Currently, I'm a financial analyst and staff writer for fitsmallbusiness.com, and there's my email there in case you have any questions after the webinar concludes today. All right, guys. So, I know how frustrating looking for startup financing can be, having worked with a lot of small businesses in the past. And startup loans they can be hard to get because you don't really have a track record with your business, or you have zero track record and you're not generating any revenues. So, a lot of the information online seems to be mostly for tech firms in Silicon Valley, right? And banks make you feel ignored unless you already are wealthy or you're part of their country club. That's why today we're going to cover these 9 best startup funding options that everyday small business owners or potential small business owners can take a look at for their small business. So we're going to go ahead and get started here. And our first option is going to be a traditional bank or an SBA loan. And we're starting here because almost everyone who thinks of business financing thinks of a conventional business loan at their bank, right? And that's how you get both of these. So these can be difficult to get, but become much easier once you have an established banking relationship. So if you're a strong borrower, then these can also become a lot easier to get. So most small business loans at conventional banks take the form of SBA loans because they're backed by the Small Business Administration. And it should be noted that the SBA doesn't make loans themselves, but through their SBA loan program, they guarantee certain loans that your local bank would make. These loans have great rates, long repayment terms, and have a large maximum size, but they are difficult to qualify for and typically take a lot longer to get funded than any other loan type. So as you can see, they're desirable because of their costs. So typically they carry lower interest rates than other types of loans or similar loans. And these interest rates can be variable or fixed, and they usually fall within the 5 to 8 or 9% range. And they have some of the longest terms available to small business owners, between 7 and 25 years. You can get up to $5 million generally with an SBA or traditional bank loan, or more, depending on what your situation is and what your relationship is with your local bank. And some commercial real estate loans can get you up to about $20 million. So to qualify, you're going to need great credit, a credit score of 680 plus. You need to be a prime borrower. You need to have strong net worth with potentially some real estate collateral of 50% plus. You need a down payment of 10 to 20% or more, which can be a nice equity injection for your business. And you need direct industry experience at a high level. So either you need it directly or you need to prove that you're going to be hiring someone that has industry experience and it's proven to be able to be successful in the industry of your business. So who are these loans right for? Well, they're right for the strongest borrowers participating in safe, well-known industries. An example of a well-known industry would be like a food manufacturer or a doctor starting their own practice. So, if you have collateral, if you have the right amount of cash for a down payment, and if you have that traditional business with a familiar revenue model, then you're going to potentially be very successful in trying to get an SBA loan. If you think you might qualify, you can get a startup SBA loan from your local lender. But startup loans for SBA loans are more difficult to get than normal SBA loans. Just keep that in mind. But everyone else that doesn't fall into this category of having the right collateral, having the right down payment ready to go, or not having the right type of business, they're going to struggle to get these loans. So, businesses with non-traditional business models, businesses that might be considered participating in a vice industry like gambling, or applicants who have a criminal record, or who are not U.S. citizens, you're going to struggle to get these types of loans. It should be pointed out that you can have a criminal record and still qualify for an SBA loan, but it can be more difficult to qualify, and there will be more documentation and paperwork that's required. Some special considerations for SBA loans. SBA loans for startups are difficult to obtain. It's possible, but it's a lot harder than other SBA loans. It's not uncommon for funding to take 2 to 3 months or more. We've seen a lot of SBA loans take 45 to 120 plus days, depending on how prepared you are, what kind of questions there are, what type of borrower you are. There's just a lot of questions and things up in the air with an SBA loan, and it can take a long time to get funded. And the application process is time consuming meaning that it takes you away from your business because it's document intensive. You're providing more and more documentation all the time. You're on the phone talking to your lender, getting asked more and more questions, and it can take your eye off the ball within your own business because of how time consuming it takes you away from your business. But it's still the most affordable startup business loan that you can get your hands on. So, you have to weigh the benefits, the pros and the cons there. But if you're looking for the most affordable loan, you're willing to put up with all of the headaches or the extra documentation and the time it may take to get funded, then it could be the right option for you. All right, guys, our second option is a rollover for business startups, or a ROBS, as it's commonly referred to. In our opinion, this is the best kept secret in startup financing and in business acquisition financing too. So ROBS is when you use your 401k or your IRA or other eligible retirement account to fund your startup without paying early withdrawal penalties or taxes. It's not a loan. It's not even a 401k loan, and it's not cashing out your retirement account. Instead, a ROBS rolls funds over into a new 401k account that will be investing in your startup. So this 401k plan benefits you and your eligible employees within your business. And it's, again, the best kept secret in startup financing. So, we're going to cover what a ROBS is and what the general terms are at a very high level. But if you feel like this is the right option for you, we have something additional to offer you today. We're actually have a specialized ROBS webinar that will take place shortly in the coming days and weeks for you to be able to participate in. If this is the right funding option for you, or if you want to learn more about it, we suggest you sign up for that webinar and see if it's right for your business. So you should be able to see in your chat box right now a link that you can click on and sign up for that webinar if you think that would be a good option for you. All right, so some common details about a ROBS. Again, you're using your retirement account. You're using your current 401k funds or your current IRA funds without early withdrawal penalties and without taxes, which is typically what is tied to these accounts if you try to take money out of them. But a ROBS is allowing you to use those funds, roll them over into your business, and you don't have to pay those penalties or taxes. So there's typically, to set up a ROBS, there's going to be a $5,000 fee up front, and that fee is going to have to come from money that is not currently in your retirement account. So it's kind of like a down payment, essentially, money that you need to come up with. And then there will be an ongoing maintenance fee, usually around $200 a month, as you work with a partner that will help you administer your ROBS correctly. Your funding size needs to be $50,000 or more that's currently in your retirement account. Some common qualifications. Qualifications are that you have at least $50,000 in your 401k or IRA, that you're a C corporation. One of the requirements of being a C corporation, it could be restricting to those that like setting up their business as a limited liability company or another legal entity. But being a C corporation is vital because essentially you're selling shares of your business to a retirement account, and you can't do that with an LLC or an S corp or any other legal entity except for a C corp. And you need to work in your startup full time. So this is not a good solution if you're trying to invest money in someone else's business, like your nephew or something. Or it's also not a good option for passive income businesses like real estate investing. You need to be working 35 plus hours a week in this new business and for the duration of the time that you have your retirement funds in the business. And you need to offer an employee 401k plan. So if there are additional costs associated with administering a 401k plan, if that's not something you're interested in doing, then a ROBS isn't right for you. But a ROBS can be a great cash flow solution, since there's no large loan repayment. So there's a lot of benefits to using a ROBS because it's probably the only solution that we have today where you don't have to pay it back. So how a Rollover for business startups, or a ROBS, works, essentially there's 5 main steps to setting up your ROBS. First of all, you have to create your C corporation. Then you create a 401k plan for that corporation. And once that 401k plan is set up, you can transfer funds from your personal retirement account to the company 401k plan. Then the plan uses those funds that you've transferred to purchase stock in the corporation, in your brand new C corporation business. And then once it does that, then the money can be used, the proceeds from the sale of stock, they're used to start your new business, to buy a business, or to recapitalize a business. So these funds can essentially be used at that point for anything that benefits the business and the employees, anything that moves the business forward. It can't be used for personal expenses or anything like that. You can't put the money in your business and then have the business buy you a new Ferrari with those funds. It needs to be for a business purpose, to grow the business or to buy the business or to pay off the business's debt, something like that. So who's this option right for? Well, essentially, it's right for anyone with $50,000 plus in a 401k or an IRA account who will be working full-time at their business in the startup. If your startup has an immediate need for cash, this is probably your best option. You're going to get money very quickly within your business. Or if you're unlikely to qualify for other financing options because of serious credit marks, this could be a good option for you, because with a ROBS, you don't get your credit checked. There's no restrictions in terms of what your credit profile looks like. Or maybe you just don't want a loan. You don't want a monthly loan payment. You don't want to burden your brand new business with debt right from the get-go. Then a ROBS is the best option for you, because there is no monthly loan payment. You're not making any debt payments at all, and you don't have any obligation to pay that money back at any time. So who's going to encounter issues with this? If you have less than $50K in your retirement account, or if your retirement funds are in a Roth account or certain pensions, then you're not going to qualify. So it needs to be a deferred account. A Roth isn't going to work for this particular option, because Roth accounts can't be rolled over into a ROBS per the IRS rules. But if your startup is designed for passive and absentee ownership, you're also not going to qualify, or you're going to encounter issues in trying to get a ROBS, because you need to be working in the business full time. Or if you're unwilling to provide employees a 401k plan, maybe because there's additional costs, or you don't have to worry about administering a 401k plan, then you'll struggle with this issue, because that is a requirement. So some special considerations. A ROBS can be used as a down payment for an SBA loan. You can combine them both. So, if you've got a smaller amount in your retirement account, if you're using a ROBS, or if you have, $50,000 in your retirement account and you need an SBA loan for $500,000, but you don't have the down payment, you can use the ROBS, put that money in your new C corporation, and then use that $50K as your down payment on your SBA loan. It works great with an SBA loan. A ROBS can also be used in conjunction with other startup financing. So if you're looking at any of the other options that we have later on, a ROBS works great with pretty much any of them. And you get access to your retirement funds without taxes, without penalties, and without having to wait till you're 59 and a half years old. And there's no impact on your credit score. There's no loan payments, and there's no depleting your liquid savings. This is a great option for your cash flow for your business. And it's a great option to get access to capital without having to pay anything for it in terms of a monthly loan payment or worrying about debt that's hanging over your business's head. So if you're interested in this option, we're going to be holding a ROBS webinar, like I mentioned, within the coming days and weeks. So we suggest that, again, you click that link in the chat box right now and sign up for that webinar. Make sure you don't miss out, because this can be a great option for your business. It could be the right option for you. And we'll get you hooked up, and we'll talk about this ROBS in a lot more detail to help you know for sure whether it's right for your business. All right, number 3 is a home equity line of credit or home equity loans. So, our third startup funding option here is a HELOC. It's basically where you're tapping the equity in your home to finance your business. So the bank uses your home as collateral, and they'll lend you somewhere between 80-90% of the real estate value or the equity value of your home. So you're going to see pretty low interest rates with this type of financing. You see here, it could be variable or fixed, but typically 3.5 to 7%, very, very competitive with any other financing. The loan sizes are also going to be limited to make sure that they can always collect, which is why they only loan 80 to 90% of the equity that you have. So it's a very safe lending option for your bank, which makes it an easier process if you qualify and allows you to have those lower rates. The terms are going to be between 5 and 15 years. There's a potential that you could see an arm or a balloon in those terms. So you could see a 5-year term with a balloon at the end of the payment. So if you end up with those types of terms, you may use this as a short-term financing solution and want to refinance or pay off the loan before that balloon's due. And then, your loan size, like we mentioned, is going to be 80 to 90% loan to value, which could be a good option for you. Some common qualifications. You still are going to need to be a pretty strong borrower. You need good credit. You need a low DTI. So debt to income or debt to income ratio is calculated by taking your total debt and dividing it by your total income. And so you need the lower DTI, the better. It basically shows the bank how you can repay the debt once you take on these new loan payments. The lower DTI, the better, and the better option that you'll have to get financed for a HELOC. You need to have greater than 20% equity in your home. And again, the DTI needs to be under 50% for sure, but the closer to zero, the better off you'll be. So who's this right for? It's right for strong borrowers with equity in their personal real estate, someone who can document their household income and show that it's sufficient to cover any loan payments. If you're self-employed, it may be difficult, before going into this business. But if you can show that your household income is coming in and it's very clear to see the income coming in and how you're going to be able to cover these loan payments, then you'll be good to go. And if you're looking for the line of credit, it can be really, really good for you if you don't need a large capital infusion all at once. So the home equity loan, you're going to get all of your money right up front that you qualify for. So if you qualify for $100K, you're going to get the $100K and you're going to start paying interest on it. Now, if you qualify for $100K with a HELOC, you can start making draws just like a normal line of credit or like using a credit card. And you don't have to pay for interest on anything except what you actually use. Who's going to encounter issues with this? People who don't have real estate, or if they don't have a significant amount of equity in the real estate, they're going to struggle. Because again, you need at least 20% equity, and you're only going to get 80 to 90% value on that equity. So the more you have, the better off you'll be with trying to get a HELOC or a home equity loan. Or those who are unable to prove household income is sufficient to overcome the loan payments and your other expenses, those individuals are going to struggle just to get qualified. Special considerations about a HELOC. Using a HELOC as a down payment can have the drawback of reducing value of collateral and is itself another debt payment. So while it's possible, it's not a great solution to be used as a down payment, and you're risking your home in a very direct way. Whereas, other business loans, you essentially will likely be asked to sign a personal guarantee, meaning that your personal assets could be at risk if your business doesn't make the loan payments. Well, you're putting up your home as collateral for this business loan. So it's very directly in the crossfires if you can't make those loan payments. All right. So option number 4 now is personal loans. So, what if you don't have personal assets like we talked about? Maybe you don't have a 401k account with money sitting in it. Maybe you don't have a home with a significant amount of equity in it. Well, you can still potentially get a personal business loan that can be used within your business. You're going to see rates between 8 and 33%. The struggle with personal loans is they vary greatly in terms of the terms that you're going to see. You could get a personal loan from your bank. You could get a personal loan from an online lender, and they're going to be completely different. A bank may take a while to fund you, but you'll get lower interest rates traditionally. And an online lender can probably get you funded very quickly, as fast as a week or a couple days. But those interest rates are going to be much higher. You'll typically see terms between 1 and 5 years, and loan sizes in most cases is only going to be up to about $40,000. So, if you're going to need to be a strong borrower in order to get these loans, and the loan amounts are going to be less than your other financing options. So like I mentioned, you need to have a credit score above 650, so you need to be a strong borrower. You're going to have to sign a personal guarantee, whereas other loans use business assets first to secure the loan. Personal loan is directly impacted on your own personal finances. And so they're going to make you sign a personal guarantee in almost every situation with a personal loan, and your personal assets are going to be directly at risk. But they won't be at risk as much as other financing sources because the loan amount for a personal loan is going to be less. And your DTI, your debt to income ratio, needs to be under 40% for a personal loan. So it needs to be even better, again, because we're looking at personal finances instead of business finances. Who's this right for? Startups that don't need large amounts of capital, because you're only going to typically get up to 40K. Borrowers with good credit and verifiable income, again, that you can show your income coming in to your household is sufficient to repay the loan without any issue, because that DTI needs to be no greater than 40%. Or those who lack the collateral or down payments necessary for other types of financing. Maybe you don't have a down payment available and you just need to get some financing now to get that business off the ground. This could be a really great option for you. So who's going to encounter issues? Those with poor credit or those with insufficient or unverifiable household income, again, is going to struggle to get this loan. Those who have a high personal DTI, you're getting above the 40% range, chances are you're probably not going to get qualified. And those who need more capital may need a larger amount of startup funding, which traditionally we would recommend going with a ROBS or going with an SBA loan if you need a loan for those larger funding amounts. So some special considerations for personal loans. These are not great for use as down payment on SBA loans because you're going to end up making essentially 2 debt payments, right? Which could really, really hurt your business in terms of how much debt you're trying to repay, and it could put a strangle on both your business finances and your personal finances. Underwriting will not consider business revenues or potential business revenues at all. With a personal loan, they're only going to consider your personal finances. So the only thing that they consider coming out of your business would be any money that you're making as a salary. All right, equipment financing is our number 5 option here. It's a great option for businesses who rely on equipment or rely on very heavy or large and expensive pieces of machinery. So equipment that retains value, like a backhoe or a bulldozer or salon or spa equipment, semi-trucks, semi-trailers, landscaping equipment, or like we just saw in our image there, medical or dental equipment. All of that stuff is really, really great for equipment financing. And rates are good for strong borrowers with equipment financing because the equipment is used as collateral for the loan. So you're going to see rates between 6 and 30%. Again, they vary because so many different types of lending institutions offer equipment financing. For less qualified borrowers, the rates can reach that 30% APR, but it could still be a good option for you. It could be a more simple financing option in terms of getting approved because of how much the equipment is being used as collateral. You can get these loans from your dealer, a local bank, an equipment dealer, a local bank, or an online lender. Generally, there's 2 kinds of equipment financing. Both of them are going to have terms between 1 and 5 years, and loan sizes up to $500,000. But the 2 different kinds are either a loan or a lease. And so the lease typically has some type of option to purchase the equipment. An example would be the dollar buyout lease, where you pay a monthly payment every single month, and at the end of the term, you pay $1 to purchase the equipment and own it yourself. Or the fair market value lease would be where you pay a smaller amount per month to rent the equipment, and at the end of the term, you pay the fair market value of that equipment to purchase it. So in order to qualify for equipment financing, you're going to need a credit score of at least 600. You're not going to need collateral because the finance equipment is going to serve as collateral, but you will need a down payment of about 10%. Who's this right for? It's right for startups that are dependent on equipment or machinery, like I mentioned, and startups that lack additional collateral or lack a large down payment, can't finance more than 10% of a piece of equipment. Then this could be a good option. Or those interested in lease arrangements rather than purchase agreements. Could also work with other forms of financing because sometimes other lenders will allow equipment to be carved out so that you could potentially finance your equipment separate from an SBA loan or from a traditional bank loan, depending on the relationship you have with your lenders. Who's going to encounter issues? Those with poor credit or insufficient or unverifiable household income, again, are going to have issues with this financing option, or those who have a high personal DTI, or those with repossessions or bankruptcies listed on their credit report. Repossessions specifically because that's the type of financing you're working with. They would have to come in and repossess the equipment if you fail to make payments here. Special considerations. Equipment financing is good to use with the ROBs. It's good to use with personal loans. It's good to use with a HELOC. It's another very flexible piece of capital, just like a ROBs, that can be partnered with something else. It's not great with SBA loans because of the shorter terms and higher APR. And SBA loans typically want you to refinance everything into the SBA loan itself. But it does have different options in how you can structure it to either get yourself a lower monthly payment or in order to get you the best option to purchase the equipment. Maybe you can't purchase the equipment now, but you can potentially purchase it at the end of the term. Then there's some significant lease or loan options for you. So, like we mentioned, the fair market value lease, for example, can keep your monthly payment lower, but has a big payment if you want to keep the equipment at the end of the term. And the dollar buyout lease is essentially the reverse. Your payment will be a little bit more, but it's a lot like an equipment loan. You're paying the full amount essentially over the course of your 5-year term or whatever your term is, and then you pay $1 to own the equipment at the end of the lease. So equipment financing helps you preserve cash flow rather than getting a big commitment of capital from an SBA loan or a big traditional bank loan. You can spread out your payments and just finance the equipment that's necessary for your business and potentially use cash flow of your business for everything else. All right, our option number 6 is a small business credit card. This is a tool that every single business owner or every single startup should have in their toolkit. It's a revolving line of credit, and you don't pay interest on this line of credit unless you carry a balance forward. Most come with 0% introductory periods, and that you can take advantage of, that even if you need to carry a balance for a short period of time, you can do it without being charged additional money. And you can even use it to take advantage of cashback rewards or travel rewards. It's an easy way to build your business's credit score. You can get additional cards for your employees and control their spending privileges and potentially get reporting, which makes it reporting on how much they're spending and where they're spending your business finances, so that you can make it a lot easier on yourself to do your end of year accounting. Credit cards are a great option to combine with pretty much any other financing option. You're going to see rates between 10 and 30%. If you get credit cards at a credit union, they max it at 18%. But you could potentially see credit card rates as high as 30%. You're going to see 0% initially, and the better a borrower you are, the lower that interest rate is going to be. The loan sizes typically are up to $100,000. But right away, especially as a startup, you're going to see something much lower than that, probably less than $20K. And then again, you can get cash back, you get rewards, you can use it for employee cards. You're going to need a credit score of 640 plus. They're easier to get approved for than personal loans, these credit cards, but you still need to be a decent borrower. You need a low debt to income ratio. And you don't need any red flags in your credit history. If you have a bankruptcy, especially recent bankruptcy, or you have a tax lien, you're not going to qualify for most of these credit cards. So who's it right for? Well, my favorite saying is basically, who's it not right for? Like, these small business credit cards are right for pretty much every startup, every small business. It's probably going to be the first form of financing that you can qualify for, and you should have them if you can use them, because you can use them to improve your cash flow, and you can use them for all the rewards that we already mentioned and all of the great benefits that comes with them. Those who want to build their business credit to potentially get a loan later, this is a great option for you. You can build that credit and show responsible borrowing and credit history prior to applying for the big SBA loan. Those who want a cash flow management tool and make your end of year accounting easier, this is a great solution for you. Who's going to counter issue? Those who have yet to form and register their business aren't going to qualify for a business credit card. You need to actually be in business to get this type of financing. If you have poor credit, you're going to struggle to get approved, or you're going to get a very small amount. Those who have a high personal DTI will likewise struggle, just like someone with poor credit. And those who plan to use in conjunction with other startup financing options, you may struggle if you plan to carry a small business credit card balance before getting the other financing option. Because you're going to, your lender is going to see that you currently have outstanding balances. So if you want to use it, it could go great with other financing options, but not if you're going to carry a balance on it. Special considerations. The flexibility of a small business credit card can really be a lifesaver for your business. There's going to be unexpected expenses come up. You're a startup, that's just how it is. And potentially you could have late paying customers or clients. Having a small business credit card can help you overcome those short-term cash flow issues and get you through the month, especially if your payments come at a different time of the month than when your expenses are due. And so it can really be a lifesaver. It's usually the first line of credit product you're able to qualify for, and every business should have some type of line of credit product in case of something unexpected. All right, option number 7 is borrowing from family or borrowing from friends. You'd probably be surprised how many people in your network would like to invest in your startup, right? So you can do this as either equity, or you can do it as a loan. Loan is usually the cleanest, easiest way to borrow from your family and friends, and it looks less like a handout. So rates are going to be, there is a minimum interest rate that essentially called the AFR that you must pay out so that funds don't get taxed as a gift. If you're not paying interest rate on a quote unquote loan from your family or friends, the IRS finds out about it, you're gonna be taxed for the entire amount as a gift. So the minimum rate is in this range that we have listed here, 0.74% to 2.26%. And again, the AFR stands for applicable federal rate. And there's short, medium, and long-term AFR depending on your qualifications. So, if your qualifications for this type of financing, you need to have friends, you need to have family members with sufficient savings or with sufficient amount of liquid assets. You need to have strong credit. Your chances are, if you're going to do this officially, then your friends are going to consult with their attorney, right? And their attorney is going to likely check your credit before they lend you any money. And they're going to want to see a strong credit history before they can recommend to your friend or your family member that you're a good investment. And they're going to want to see that you have experience in the industry that your startup's in. They're going to see that you have a high likelihood of being successful or a history of being successful. And they're going to want to see that you have a strong business plan that shows how you're going to be successful moving forward. This is right for, someone who's potentially looking for the cheapest, quickest borrowing option, and someone who considers themselves to have a network of wealthy individuals. So if you have that network, this can be the easiest, quickest option. We've seen it done where startups or small businesses can get people that they know to invest in their business within hours or days. Have damaged or thin credit, it could be a good option for you if you can convince your family member or friend that you're a good investment. Borrowers without collateral or without direct industry experience, again, while the family member's attorney is going to want to see these things, some family members, some friends, they'll invest in you anyway if they feel like you're a good investment. So if you can convince them that you're going to be successful going forward. And those situations, having thin credit, having damaged credit, if you don't have collateral, if you don't have direct industry experience, your business plan really needs to be that much stronger to make sure that you show and can display how strong the future is going to be for your startup. You're going to encounter issues if you don't have a wealthy network to tap. If you're ignoring the IRS's AFR rules, it can really create tax problems for you. Or those with some fragile relationships, you're probably going to encounter issues with this, because if you have a fragile relationship with your friend, you probably don't want to borrow money from them, because let's be honest, guys, every startup is a risk, and every amount of money that goes into a startup is at risk. And if you already have a fragile relationship and you want to preserve that relationship, it can be tricky, and you don't want to complicate it even further by owing them money. So it could be an issue with this type of financing. So keep in mind that if you execute this poorly, it could look like a handout. You want to make sure that you do it officially, draw up the right paperwork, make sure that you're paying interest on the amount of money you're borrowing. Depending on the number of backers that you have, it can be a headache to manage. If you're borrowing money from 5 or 10 different people, it can really be frustrating. But it could be a good option if you have that network of wealthy individuals to tap. Our option number 8 is angel investors or venture capital. So, this is a good option for businesses that are looking to scale, or businesses that have the potential to scale very, very quickly. Essentially, angel investors are looking for wealthy individuals to invest in your business, and venture capital is, of course, investment firms looking to invest in businesses that are going to blow up and scale very quickly. This type of financing isn't going to necessarily be a loan, but instead they're going to give you money and want an equity stake. They want you to give up equity in your business. They're going to characterize it as preferred stock, and they potentially could take over control of your company. They're going to want a board seat. They're going to want a say in how things are run going forward. The venture capital firm more so than an angel investor, but there's potential for both to characterize it in this way. You potentially could qualify if you're a very fast growth business with a strong core team and a strong business plan, and you have a competitive advantage in your market, and there's validation in your business idea, right? So and that validation doesn't necessarily have to be with you already making sales. That validation could be in the marketplace as long as you can provide proof of it. So it's right for startups with a superior technology solution, or startups that will require significant investments that traditional lending metrics wouldn't support, or businesses that have a clear path and a clear plan for scaling extremely fast. You're going to encounter issues if you're not a high growth business, or if you consider yourself high growth, the venture capital firm or your angel investor may not. So you could be high growth, but you may not be high growth enough for them. They see thousands of deals every single year, and they only invest in a few at most. And so you need to make sure that you're high growth even more so than other great business ideas. Startups without a competitive advantage aren't going to qualify. They're just not going to be an interest of these firms looking to have a niche in the marketplace. And startups that don't want to cede control, this is a terrible option for you, because there's a high likelihood that you'll lose complete control of not necessarily the day-to-day options in every situation, but certainly the big business decision making. You're going to be taken over by a venture capital firm that wants to make sure that their money is well invested. But it should be pointed out that many angel investors and some venture capital firms will allow you to stay in control and allow you to continue to make all of the day-to-day decisions, and they just want to be informed of what's going on unless something bad happens. If you don't want to dilute your equity, this is a terrible option for you, because your personal equity will be diluted by a venture capital firm or by angel investors coming in and investing in your business and taking equity away from you. So this may mean losing some level of control of your company. It might be a good source of seed money, but it may be a good option down the road. If you're just getting off the ground, this may not be the best option for you. But once you have some experience, you have some sales, and you need that large chunk of money, over $500,000, then this could be that option for you down the road. Our last startup financing option today, guys, is crowdfunding. This is something that's becoming more and more popular. It seems like every single year. Essentially, crowdfunding is a way of raising small amounts of money from a large number of people or investors. So, most often this is done through an exchange of equity or exchange of rewards. So the costs are very comparable to some better financing options, but usually it's an all or nothing funding option. You'll see costs and fees between 5 and 10%. Again, you're going to give a reward or you're going to give equity in exchange for that. Equity is just becoming more and more popular for crowdfunding. Traditionally, a lot of the crowdfunding that has been done is by allowing your potential customers or your followers or people who are supportive of your business to be rewarded with something amazing depending on how much money they give you. Again, it's often all or nothing. So if you say you need $100,000 and you only raise $90,000, you're not going to get any of it. To qualify, you need to be unique. You need to have a marketable business. You need to be good at marketing in order to find the backers necessary to invest in your business. You need to have a great marketing campaign. And it's not based on typical credit standards. It doesn't really matter what your credit score is. So it's another option that if you have bad financing, it may work for you. Or a bad credit history, it may work for you. So, startups using in conjunction with other traditional funding options, this could be a good option. Someone who's maybe you have an SBA loan, you're looking for more money to put into your next manufacturing run. This could be a good option to raise that money and reward those who invest in that manufacturing run without taking on additional debt. Startups without the ability to borrow or raise money from more traditional source, maybe you just can't get approved for a loan. Maybe you don't have money in your retirement account for a ROBS. This could be a good option for you. And startups looking for creative marketing techniques. Someone who is very good with creative marketing, this is a great option. Who's going to encounter issues? Businesses without marketable products or without marketable services are going to struggle because you're not going to find the backing available to get financed. Startups unable to sell themselves. If you stink at marketing, then this is not a good option for you. Startups who have products that can easily be copied and aren't prepared to scale themselves, you're going to struggle. If someone else can come along and copy your business, then people aren't going to want to put money into you. If you're not prepared to make the manufacturing run that you're raising money for, once you get financed, you're going to struggle. You're going to get egg on your face, and you could really struggle and lose customers. So some special considerations. Level of uncertainty can present some difficulties, guys. It's you don't know if you're going to get financed or not, and you won't know until you actually hit the mark, right? Because it's all or nothing. You need to be ready to deliver finished products, or your reputation could be aligned with not only your customers, but those who invest money into you. All right, so that's crowdfunding in a nutshell. Guys, this is I know we covered a lot of options very quickly today. Feel free to ask any questions you may have, and we'll get them answered as we can. But we do have some in-depth articles on our site if you're interested in learning more. But what we're offering today is what I mentioned earlier. We have a series of webinars coming up that go into these options in a little bit more detail, because I know we just were able to cover them at a high level today. So maybe you found the right option potentially for you, but you want to learn more about it. Then we suggest signing up for these webinars that we have coming up. And our first webinar in this series is going to be a ROBS webinar all about rollover for business startups. So if this is the right option for you, or if you want to learn more about it, we suggest signing up for that webinar today that we're going to be holding very, very soon. So you can click the link that's in your chat box right now, sign up for it, and we'll take care of you and make sure that you're good to go. Or you can hang around and you'll be redirected directly to the sign up page as well. Again, we appreciate your time. We appreciate you coming for the webinar today. Enjoyed having you, and we wish you luck in your startup businesses, and we hope to see you next time. Thanks, guys.